The graph is updated 3.7. What's the number of deaths though? What's the number of deaths right now? COVID. 5 something.
Good afternoon, everyone. We're just going to give it a couple of minutes so people can come into the webinar, and then we'll begin. Okay, I'm going to start just to get the ball rolling here, and then people will keep on joining in. So I want to welcome everyone to our webinar on the PPP loans. I can't think of a more timely time for us to have a webinar with looking at this. I first want to next slide, Ariana. I want to thank our sponsor, Naraki Smith, for not only sponsoring this but providing the two experts who are going to speak to it today. I also want to thank our board directors. Their support through this whole COVID has been amazing. I know some of them are on the call today, so I want to thank them personally for all the support they give the HIA-LI. And then real quick, we have a couple of programs are coming up. March 18th, we have an excellent panel, our economic summit, which is going to talk about the different industries and experts from each industry on what their outlook looks like for this year. We have a Trivia Friday coming up, which should be very fun on March 26th. And then we have a CEO forum featuring Greg Galdi from Custom Computer Specialists. Greg's a wonderful guy, and he's going to bring a lot of insight on his journey. And then last, we have our April 23rd HOPOG update on the Long Island Innovation Park at HOPOG. And there we go. So first of all, I want to thank John Spadola, Director, and Ernie Smith, Managing Partner of Naraki Smith LLP, for bringing this concept and this idea to us, because like I said, this is very timely. So I am going to also, before I begin, if you have any questions, please enter them in the Q&A field. So I'm going to turn it over to you guys, John and Ernie. And you're on mute, so you have to unmute yourself.
All right, here we go.
There you go.
Thank you, Anthony. Thanks for the introduction, and we appreciate the opportunity to be with you here today. This is a very timely and appropriate topic for what's going on right now locally in our state, in the country, right, John? When you say, I mean, we've done this presentation. We've said probably about 10 to 12 times at this point.
Yep.
And we keep updating as we get new things that are coming about, new developments in regard to the PPP and to loan forgiveness. And I guess you can be the first to announce what's being kicked around right now, right?
Yeah, I mean, right now, as we were getting on, there's some stuff dropping that the Democrats in both the House and Senate are really lobbying the Internal Revenue Service to extend the personal deadline from April 15th to either June 15th or July 15th. We've been hearing rumblings about this for a while. Obviously, nothing's done, but I think it'd be very good all around for everybody, especially with what's going on. If they are able to extend it like they were last year, it's amazing. I can't believe that we're a year out. I mean, it was a year ago around this time that everything kind of dropped. I think it was March 13th. March 13th was the day when everything really started to change. I remember the end of February, beginning of March, they were talking about it a little bit, but we hadn't really seen, we didn't think it was going to happen here. And then it kind of, it
Well,
picked up very
there's something
quickly.
out there. We knew it. I'm the chair of the board of Long Island Community Hospital, formerly Brookhaven, and we knew something was there, but there was no specifics regarding that. So we're going to talk about as much and as long as you can stand the PPP program, right? We have quite a bit of information about it. We are quite expert in this area. We've been doing this for a while. Obviously, some of the statistics are pretty, they're very concerning, obviously, with over 500,000 folks that have died during the COVID epidemic, and almost 10% of those deaths are in New York at 50,000. So, and climbing.
Yeah, I mean, this is a map from the other day. I brought the limiting conditions up before that, what we say today should only be used as a guide, and to consult your professional, your bank lending institution, so on and so forth. But this is the Johns Hopkins. We go here all the time just to take a look at where we are. There were times this entire map was red.
Yeah.
It was just deep red across. We've done this presentation different times amongst the last year, and I always update it when we do it. Obviously, we had that uptick around the holidays. It was
expected.
It was expected.
And we're now in a downtick.
Yes.
Because now it's down. We're on the back end of the curve. The next uptick is predicted for the end of May, beginning of June. And it has nothing to do now with holidays, but more the variants. So that's what the thought process is, that we'll see something that has to do with the variants at this point. People are being vaccinated. We have more vaccine out there finally, but it's still going to take a while to get people vaccinated.
It was 2-3 weeks ago, somebody from Johns Hopkins said that he thought we'd be out of the pandemic in April. With his thought process that as more people get it and more people get vaccine and it comes to the middle, that, we would be out of the pandemic piece. It would still be around, but it wouldn't be as bad. I don't foresee that happening, but I don't have PhD at the end of my name.
Yeah, but you're probably right. This is just the history. And now this started off with a much shorter slide during our first presentation, some 11 presentations ago.
Yeah.
And now you can see we've got a timeline that goes back to the president first introducing the Family First Coronavirus Response Act into law back on March 18, 2020, all the way through the current year. We should just pick up a couple of highlights, John. I think the one thing is the sheer size. I mean, the magnitude of the dollar amounts that were in play at one point, some 670 billion, the two combined numbers, right? And then, of course, you can talk about the taxability issues. They were the big surprise, and then the big help.
Yeah, so CARES Act comes out. It's funny, the CARES Act was, I don't remember how many pages, it was probably about that big. And then the Consolidation Act that came out in December was about that big. And the difference being, they were funding the government with everything. But yeah, I mean, the CARES Act came out. It was very clear that the forgiven PPP loans would not be taxable. They were trying to prop up the economy and what was going on. And, everything crashed overnight. I mean, I talked to Ernie on a near daily basis, and I could kick myself for not buying Disney because when it went down, I said, this is the easiest buy in the history of mankind. They're Disney. They're not going anywhere. Naturally, I didn't buy it, and now they're back up to where they were. I probably would have made 90% gain. But everything fell off, and they put a bunch of money in. And then the IRS came out, and they kind of backdoored it and said, yeah, we're not going to include it as income, but you can't deduct the expenses, which by default makes it taxable, which was a problem. And it was an issue across because everybody was getting these loans, expecting them to be forgiven and not taxable, and the IRS said no. And if you take a look at this list, May 20th, the application for forgiveness comes out. June 5th, President Trump at the time signs a flexibility act.
That March was when they came out with it. I remember because you were in the office and I saw you.
It was at the end.
I was walking out and you said, "Oh, the IRS just came out and said."
It was April, the end of April.
Yeah,
and
it said they're not going to allow it to be,
it turned everything.
On April 30th.
Yeah, turned everything on its head.
Turned everything on its head and really made people, be pushed back. And we spent the rest of the year wondering what was going to happen until they finally gave us some relief at the end of the year and said, hey, it's not going to be taxable.
Yeah, but it took a long time. There's a big gap between June 5th and November 18th, and we all know why. It was an election year, so not much was getting done in Washington. And although the senators and the members of Congress in the House, on both sides, Democrats and Republicans, were really pounding the table about the fact that they were unhappy with what the IRS did, they ultimately weren't able to do anything about it. So there was a lot of uncertainty on our end from an accounting perspective on what was going to occur. And then right before Thanksgiving, the IRS dropped a bigger bomb, a nice little present, saying that, well, not only that, you have to pick the income up in 2020 for the PPP, which became a problem. And I'm sure a lot of you on this call, you might have been having conversations with your accountants. I know the accountant should have been reaching out to you and saying, hey, listen, this is a problem. You may have to make a big estimated tax payment. And what we were doing is showing everybody this is what you owe with and without in case Congress does something. And thankfully, on December 27th, after a little back and forth by President Trump about whether he was going to sign it or not, he signed the Consolidation Act. And what that did was it unequivocally overrode the IRS and said this will not be taxable, which really did help. And it created the PPP 2.0, which we're going to talk about today, the second cut at the apple, the second loan that you can get. So that's January 8th, January 19th, the new applications come out. February 22nd, another surprise that we didn't expect.
Well, he came out of nowhere with that announcement.
Out of nowhere.
We're gonna protect the sole proprietors, and now we have the March 6th, the Senate approval of the $1.9 trillion stimulus package. Now we just wait for the House, which seems like it's going to happen, and we're going to have a large amount of dollars that will be available once again, in this $1.9 trillion stimulus package, which we're going to have. We have a series of slides we're going to go through to highlight what's there. But that's, again, another round of big spending, and every day there's people back and forth arguing over whether we should do this or not, but we're doing it. So.
Yeah, we're going to pay for it. My kids are going to pay for it. My kids' kids are going to pay for it. Maybe my kids' kids' kids will pay for it.
It's going to be sovereign debt.
Well, Ernie's
100-year bonds.
Ernie's been on this kick for years. We should just refinance our debt on 100-year bonds at a really low rate, and it'll solve a lot of the problems that we run into. But this new plan, I can't imagine it not passing. The Senate passed it. That's really where the roadblock would have been. Manchin held out a little bit. Who, although he's Democrat, he's more moderate, and some things were changed last minute. So now it's got to go back to the House, and the House has to reconcile. We fully expect it's going to be signed. It'll be signed by President Biden by the end of the week. And Schumer came out today and said that he expects the checks to go out for the end of the month.
Yeah,
the new stimulus checks, which we'll talk about.
And again, we know because there are people that are winners, and there's a lot of winners and there's losers in this one. It's a lot different than some of the other crises we've seen.
Yeah,
much different.
So the new plan, when it's going to be the new stimulus when it is passed, is called the American Rescue Plan Act. It's $1.9 trillion as of today. And we're going to go over some of the items that you're probably hearing about in the newspaper, and your accountants are probably talking to you about some of the things that are going on and are going to be impacted by this deal. Yeah.
So these are again $1,400 stimulus payments to everyone. Okay, and again, this is the.
I wouldn't say everybody. Depends on how much you make.
True. There's a cap, right? But it's potentially everyone is potentially eligible. Individuals and their dependents making under 75 will receive the full payment with a phase out of 80,000. With a family of 4, it's 150,000 will receive a full payment with a phase out at 160. So a family of 4, they're going to get 4 checks. So it's a big payment.
Yes, it's a big payment. What is different from this stimulus check than the other stimulus checks is the phase out was much higher, where you were looking at 75 to 100, 150 to 200. So more people were getting the stimulus checks. What has happened is that the phase out has been reduced. So now, if you made 180 grand, you might have gotten your past stimulus check. Now you're not getting anything on this end. And that's the biggest thing with this stimulus, is that it's going to go to less people because of what they've done with the income brackets. And like I said, Schumer said yesterday he expects, if it's signed this week and all goes well, which is what it's on track to do right now, that the stimulus would be out by the end of the month. I fully expect many people not to file their individual income tax returns for 2020. If their income levels would change, because it's going to be based upon 19. I don't, I question whether even if a return was filed today, if the IRS would process it in time, but we have returns that
Takes
are,
months to process right now.
we have returns that we
Yeah.
filed in June that still haven't been processed, electronically filed, and they still haven't been processed by the Internal Revenue Service. So it's tough, they're working from home, they're understaffed. So it's, anything that you send from a paper standpoint, it's been taking months to process also.
I think these caps are good because hopefully it gets the money in the right hands, the right people. That's been the big rub with a lot of people out there, is that the wrong people are getting money.
Yeah.
So I saw a stat today of the folks in the 30 to 35 age bracket. 50% of them are going to invest half of their money in the stock market that they get from the stimulus check.
Really?
Yeah.
Is it going to be GameStop again?
No idea. Right? So this is a big relief. Nice child care credit, increase the child care credit for 2021
Yeah,
to 3,600, which is.
what's important that is it's 21. It's not 20. And I think we've had a lot of questions in regard to that, and confusion. It's for 2021. So it'll be the tax return that you are filing in 22. Right now, the credit is $2,000.
Right.
There's
And the other limit that's right there.
Yeah, with the limits, I didn't go into detail on what part is refundable versus unrefundable. We're keeping it fairly general, but it's going to go from $2,000 a child to either $3,600 if the child is under 6, so 5 and below, and $3,000 from 6 to 17. But again, there's income limits here. So what they're going to do is they're going to phase it out fairly quickly. But from what it said, we haven't seen the text yet, but from what we've read, it won't go below the $2,000 that it's at now. So, again, trying to put the hands and the people making less money to try to stimulate what's going on and help with what everybody's experiencing. What's a little different too is just like on a healthcare end, if you have the marketplace and you can get an advanced credit on your health insurance, they're allowing people to get an advanced credit on this for the second half of the year. So you'll be able to say, listen, my credit is X, and get it spread out over 6 months and then claim the rest on your tax return. So it could be $250, $300 a month that they're going to be sending out to people with this credit.
Yeah, the metaphor that was given today, it's like turning on a giant fan and blowing cash throughout the country, Student loan forgiveness with exempt student loan debt, from being forgiven, being taxable through 2025. And they've been back and forth. Did they settle on the amount? Is it 10,000?
I don't think that I didn't see anything in regard to actually forgiving debt.
So over the weekend, he said 10, wouldn't be any more than 10,000. At one point, it was at 50,000. We're going to forgive 50.
50. I don't
think it's.
I don't know if there's anything in here and that there's nothing that I've read that specifically said they're going to forgive debt with this.
Yeah.
I think it was that they're going to exempt debt. But I think this is, if not, this is a precursor to, I think, maybe doing something with student loan debt subsequent to this bill.
Well, it's the next big bubble.
Yep.
We know that. It's a big one. It's been talked about for a while. What Biden said over the weekend was he wouldn't forgive any more than 10,000.
Yes, that's originally it was higher. Now it's 10.
It was 50 now.
I think the people that have issues with it is the inequity of the fact that you have people that paid all their student loan debt off and struggled.
I paid all mine.
Well,
Did you pay yours?
No, so
different times. It's a whole different era.
But even in the younger generation, the people that I'm talking to that have paid off and struggled through paying off, they're like, oh, I would have been better off just not paying off if that's the case.
Yeah.
And that's we do hear that argument somewhat.
So unemployment continues.
Unemployment continues.
Yeah, it's like Groundhog Day.
Yeah.
Right? We're going to keep continuing with unemployment 300 a week until the beginning of September. Right. Currently, it's supposed to end now.
Yeah, this month.
Yeah, this month. And the taxability, now this is a big one.
Yeah.
Retroactive to 2020. Go ahead.
We probably have, we have a number of tax returns in this office right now that were on an individual end that were being prepared to file that I have to hold back now because in this bill, they're going to retroactively exempt the first 10,200 of unemployment from taxes. So I got a bunch of people right now that owe money because they didn't withhold on the unemployment that now probably I owe money because they're under the $150,000 threshold and they received the unemployment. So
Mhm.
what they're really looking to do is to say, listen, we understand everything that's going on. For the first 10,200 that you got in unemployment, you're not going to have to pay tax on it. So on the flip side, I got people that withheld, they're going to get all that withholding back now. So, we're not big proponents of filing a tax return to then amend it 3 or 4 weeks later. So really what we're waiting for is for this to pass. And then what's eventually going to happen is I would assume they're going to update the forms. There may be some checkbox or something on the return or some disclosure of the amount that's being exempted, or they may just come up with an entire new form that has to be completed. So I do expect that if this gets passed, which it looks like it is, it may hold up returns for weeks, which would then come into line with the filing anyway. Meaning, we should push off the IRS filing, which, maybe this was a precursor to giving some leverage from the Democrats and Republicans to kind of pressure the IRS.
Well, this was a tax season, was supposed to happen, right? February 12th was the original
Yeah.
forms came out, so I think we're struggling with all of this at this point.
Yeah, and in a normal year, it's like mid-January.
Yeah.
The latest that I can remember is late January with tax changes.
It was always January, never ending in
February 12th was the first tax return that you could file, and we still have a lot of forms that aren't even released yet, that are still in draft from the various governmental agencies. So there's returns that are done that I can't file. And it's March 9th. So it gives you an indication of what's going on.
This is the big one. When you start to look at these numbers, it's just astonishing how big the numbers are. 350 billion aid for state and local governments. By the way, do you know what New York's total number is estimated?
No, what?
50 billion.
For the gap?
No, is what we're getting of this whole package.
It's funny because Schumer the other day said 100,
Really, I saw 50 to that.
but they've only outlined, he said 100, but he only outlined, and I have it on the bottom of the slide,
Yeah.
what is that, 25, 30, about 40 to 50. So, it's funny because when I saw what he said, I was saying to myself, where's the other 50 that he says that we'll get?
I went on the New York side today. It said $50 billion.
I trust that more than
But
comments.
look at where the money's being put. 160 billion for vaccine and testing programs to help the spread. Obviously, that's where we need it. 25 billion in new grant programs specifically for bars and restaurants. That grants up to 10 million, and we've seen that these kinds of funds before. They could pay for payroll, mortgage, rent, utilities, food, and beverages. They've been hit so hard. I mean,
It's a brand new grant, different from the PPP.
Yeah.
There's not a lot of details right now. I think the actual amount today they came out was like 28.6 billion, I think it is. So
Yeah.
we'll see after this passes, how long it takes to implement it and so on and so forth.
I think the exciting thing is the 15 billion to the EIDL loan programs. I think people forget sometimes that they're out there.
Yeah.
We have a lot of clients that took those.
Yep.
And we've urged them to keep this money. This is great. It's all for working capital. That's what it's specifically for. Great terms. If you're 200,000 or less, there's no personal guarantee. It's 3.75% over 30 years.
For working capital, not buying a Ferrari.
Right. You can't buy a Ferrari with that. Yes.
We do fraud presentations too, and there's plenty of those stories that we did one 2-3 weeks ago about stuff, people doing things like that.
Yeah. And of course, a lot allocated to schools, 130 billion. We need to get students back in the classroom, and we all know that. And the big concern is, regression, and how do we fix that? And that's what's really, really important. And then, John, I think you added something a little extra about New York. Like I said, what I saw today was about 50 billion.
So there's just 2 questions that came in on the slides. We'll send them to the HIA to distribute.
Sure.
Oh, you know what? We have the list. We'll send it to
Yeah,
everybody.
we'll send it to everyone.
As far as the EIDL loan, I don't believe you can qualify twice. Somebody's asking,
Mhm.
can you get 2 EIDL loans? I mean, I haven't seen anything.
I don't
It
think
would
so.
have to be a separate disaster, I would believe. And there may even be requirements about having a loan already when you qualify.
Mhm.
I haven't seen it. I don't think you've seen it.
We have a lot of people who've been frozen in their EIDL application right now since this new PPP came.
Yeah.
And I think they're sort of backlogged on that side as well.
The PPP has also been basically locked because when Biden came out on February 22nd, he gave a 14-day period only for basically sole proprietors, which is different than what he did with the revenue, which we'll talk about in a few minutes. Oh, the New York.
Yeah.
Yeah, so somewhere between 50 and 100 billion, I guess, depending on what you see.
Yeah.
with 12.5 billion going to the state, 9 billion going to the city, 6.5 billion going to the MTA, and 6.1 billion going to New York City. I'm sorry, the 9 billion is going to the school districts. I know that, my school district is, based upon the budget that Cuomo has
Yeah.
taken out, is getting shorted the most of anyone in the state.
He did.
So
He really did take out a hatchet to you folks.
he did. I'm not quite sure why, but hopefully this 9 billion helps, and maybe we're not cut as much as he said he was going to.
Yeah, I think they're not concerned as much about this year. They're now concerned about 2022
Yeah.
and thereafter, and then, more programs, 800 million for, alleviating youth homelessness, temporary subsidies for those purchasing health insurance through the Affordable Care, Marketplace, which is back.
Yeah.
Obviously, that's back. Coverage of full premium for COBRA insurance through September for those who qualify and lost their jobs. 15% increase in food stamp benefits through September. 20 billion to state and local governments to help low-income households cover back rent assistance, and utility bills. So on top of what they're already providing, state and local governments, another layer of dollars, and then continue to provide tax credits for COVID, which we're going to talk about today. Some of the tax credits for COVID as well. So it's a lot of funding. So folks should understand that the funding from the prior bills hasn't been spent yet.
Yeah.
So that money has not already been spent. So there's a lot of money that's out there. Even the PPP had 100+ billion left over that they never distributed in the first round of PPP. So there's a lot of funding that's available. There's a lot of infrastructure funding that's in the bill as well that we didn't present today. But there's infrastructure funding as well that will be helpful, and that should help to add to jobs as well.
Yeah, I had a question just to follow up with the EIDL loan. So the EIDL loan is directly administered by the SBA. So I would go to the SBA and talk with them directly and or go through the application process. There should be indications on there about whether you have loans with the SBA or not, and that'll direct you. But yeah, I would go directly with the SBA. The EIDL loans are not with the banks. Unlike the PPP, where really a bank is underwriting that loan and then bringing it to the SBA, the EIDL is directly with the SBA.
Yeah, and we have a few slides on it at the end. The EIDL piece. All right, the PPP. By the way, this was a brilliant program. You have to admit. When we were in this office back last year and we watched Mnuchin say, we're going to have money in everybody's hands, we said, okay. We went back to work. We said, we'll see what happens. And then they put all this money in people's hands. It's incredible, So, we have first draw loans, have 500 fewer employees, number of employees, not FTEs. That's a very important one, or satisfy other SBA small business industry standards. We did have one client that met that. It was a large employer. In business as of February 15, 2020. And now we're at the second draw, 300 or fewer employees, so there's a bit of a limitation.
Yeah.
Number of employees, again, not FTEs, or satisfy other small business SBA industry standards. In business as of February 15, 2020, have a reduction in the revenue of at least 25% any quarter in 2020 when compared to the same quarter in 2019. Loans less than 150 not required to provide supporting documentation of decrease until forgiveness application. I don't know that they could make it any easier for people to get themselves in.
Wow.
What's your thought on that?
So I would say that the attempt was to try to make it easy. I think in the application, and we'll go through some of the shortfalls that we've seen since this was passed, since the Consolidation Act was passed and PPP 2.0. For loans less than 150,000, you're not required to provide the information, which for some people it takes some time and energy to put together. They don't have ready books. However, on the underwriting piece from the banks, we've seen a lot of requests for this information, even though the SBA directly indicates you don't have to provide it. And we'll talk about some of the things that we've experienced over the past 8 weeks, and the frustration from a borrower standpoint and the consultants that are helping them. What's very important about the second PPP loan is also not only do you need a 25% decrease, but you also have to have used or will use the first PPP loan before you receive the second one. Just to circle back, there's another question having to do with the COBRA. They haven't released the COBRA insurance that we talked about in the new stimulus that hasn't passed yet. They haven't quite released what the requirements is going to be, but the program is supposed to cover COBRA insurance for people that lose their jobs. So it would be a benefit in addition to your unemployment. We don't know yet, because we haven't seen the text, as to what those requirements are going to be. I am sure they're going to be based on income limitations and so on and so forth. But as this, comes out, and once it's passed and we get through all the text, we'll be able to see. But on the PPP loans, they've obviously, what's going to happen is less people are going to qualify for the second PPP draw because they went from 500 employees to 300, right? Less people are going to qualify because now you have to show a reduction of 25%. I mean, that's probably,
Massive.
50, not even, maybe 30% of our clients qualify, 20.
But if you think about it, if you have a 25% or more loss,
Yeah.
most of the businesses we deal with, their expenses are fixed.
Yep.
You are hurting.
Yeah.
You're hurting really bad. There are a lot of people that qualify just for 1 quarter. They
Yep.
satisfy the 1 quarter requirement. We have urged everyone who qualifies to apply because there is too much uncertainty right now. I mean, we're all happy now. We feel a sense of momentum,
So the
but
low,
there's way too much unknown right now still for the future.
so these are just the maximum loan amounts, the first draw amount, which I'm sure a lot of you have already received, based upon 2.5 times monthly payroll. Maximum loan amount was 10 million. After a handful of weeks, they came out and said, okay, anything over 2 million, we're going to audit you and you're going to have to complete an uncertainty questionnaire to basically prove to the SBA that there was uncertainty and you needed the loan. And that uncertainty, and we'll go over it in a little while, is both, because of a reduction in revenue and also liquidity. Did you have the liquidity to survive? And we don't really know how the SBA is going to look at this, to be completely honest with you. The way, the example that I give to people is, it's sort of like when you're driving down the road, there's a speed limit, right? There's a speed limit of 55. You can go and pass a police officer going 65 and he may not pull you over. And then you can pass another officer and you're going 57 and he pulls you over. So what's the level of reasonableness that they're going to look at, or is it going to be a hard and fast rule? Anything over 55, is out. Versus, hey, everybody's going 65 and going with traffic, I'm not going to pull the person over. We don't know how they're going to administer this program. If they're going to say, listen, you had 5 months of working capital in your account, so you didn't have uncertainty. I think we both believe that, it would be a shame to have them come back and Monday morning quarterback when, the whole world was ending last March. I mean, if you just stop and think about what was going on, the level of fear and uncertainty during that time period, we're in a much different spot now than we were then. The year has passed. We're in a lot different spot. The other day, they were talking about, they think they found a treatment potentially,
Right.
For COVID, that it could take months to get it approved. But the initial trials, they think they found something that's similar to a Theraflu or a Tamiflu for the flu that may potentially, be used as a treatment for COVID. We're in a much different spot now than we were last year. Nobody knew what was going on.
I like your metaphor. I mean, I like the whole speed limit issue. We know that the SBA is not really equipped itself to deal with this, so we're not sure if it's going to be at the bank level or it's the SBA. We know the banks don't want the loans. They would prefer to have them forgiven and not keep them and service them. And the certainty application, when you look at it, it's daunting. It's a very daunting application. And we really have no idea what this $2 million audit's going to look like. But it's in both the first draw, the second draw. Second draw is different.
Yes.
2.5 times monthly payroll and 3.5 for your NAICS code 72 accommodations and food services. So they're really trying to hit the hard hit industry of hotels, and
Restaurants, hotels, stuff like
all
that.
those that fall in there. Max loan to $2 million.
So now they've capped it.
Yeah,
So it used to be 10, now it's 2.
but I think they needed to. I think
Yeah.
it was, they put out too much in the first one. They were criticized for that. Again, we had the uncertainty questionnaire. We have the sole proprietors can use gross revenue. And that was another Biden thing.
Yeah, that was
Come in and
February
rescue the
22nd. Yep.
Sole proprietors and help them out. And he's,
Listen,
so far they're moving in the right direction.
yeah, I mean, we had a number of we don't have a lot of Schedule C clients, but we have a handful that couldn't qualify because they weren't showing a net profit, right? The revenue minus expenses equals your profit. Well, now that this has changed, we're gonna apply for them because based upon revenue, they'll get, I mean, the max you can get is like $20,833, I think.
Yep.
But now they qualify where in the past they didn't. So this is gonna open up for a lot of small businesses. The problem is the program ends on March 31st. So there's gotta be some movement. There's nothing that I've heard of.
They haven't given any dollar amount yet, as where the, what's been,
The
what's been
last
approved.
time that I saw a update was about a month ago, maybe 5 weeks ago. I think there was 80 billion left.
80 billion left. So
I
there's
thought
still
that's what it was.
200
I'm going
billion.
off a recollection. I could be wrong.
Yeah, they'll replenish if they need to.
Yeah.
But I think it's important. I think you should bring up the first draw, second draw. If you miss the first draw, what can happen when you come to the second draw? It's an important question.
Well, if you miss the first draw, you could still go for a first draw. I mean, the second draw only comes after you got the first draw, right? So let's just go back to one of the prior slides. You had to have used the PPP funds from the first draw, or will use them before you get the second draw. So we had a client that closed. It was a daycare that closed and did not take the PPP first draw, and then she reopened, and I want to say it was September, October, and she just applied for the first draw. So that's way after the fact of when it came out, but it's still considered a first draw because she never applied for the first one. So by second draw, they just mean it's the second time you're getting a loan. If you didn't get a loan already, you can still get a first draw loan.
There's still 100 billion left in that
Yeah.
program, technically, So,
This is just the application. I'm not gonna spend a lot of time, but this is just so that you can see what the applications look like for those of you that maybe didn't fill them out. Obviously, you're looking at, if you get towards the bottom, your average monthly payroll times 2.5%. And they want to know your number of employees. This is updated. It didn't always look this way, but this is the most recent one. What's important is they want the number of employees as of your base period, not today. And that has caused some issues. And there was some mixed signals from the banks and SBAs as to what number belongs in there. And on the second draw loans, it's kind of caused some issues with some clients. But they want to know why you want the funds: payroll, rent, utilities, covered expenditures, property damage. We'll talk about all these. These are the areas that you can use the funds and have it forgiven.
yeah, and we've done a number of apps for clients. So
Oh, yeah.
check many of the boxes for that.
This is just the new one for the Schedule C. It's basically the same thing, but adding, hey, listen, if you're going to use your gross revenue, and that's the part in the middle, how to do that. So it's just an expanded application. This allows the sole proprietor to get a loan based upon the revenue rather than their profit.
Yeah, one of the banks we work with has a lot of sole proprietors. They have a lot of professionals.
Yeah.
They have, doctors and lawyers and so forth. And they had a lot of people that didn't qualify the first time. They couldn't figure out how to underwrite.
How to underwrite it.
that.
This is just a second draw application, very similar to the first. The one major difference that you see is at the bottom. It's asking for the loan number from your first draw loan. And then it's asking for the gross receipts reduction. They want to know, what quarter are you using? What's the reference period? And what are the gross receipts? So if it's Q2 2020, you'd put that there. You'd say $100,000. Your reference is Q2 2019. It was $300,000. That's more than 25%. You qualify.
Yeah, and talk about, what we've done. We've taken it and actually attached the schedule to the back of it. So we've taken it right out of, whether it's QuickBooks, wherever it's from, and provided so it's very easy for the underwriter to see where it's coming.
I have two elementary age children. The way that I put it to my staff and people is we should make it easy enough for the underwriter that my kid can understand it. They're going through a lot of applications. So I give them credit. A lot of these people are not trained. At the first go around, they were taking bank tellers to go through these applications to get things out to their borrowers. So make it as easy as possible for them. So we create a schedule, we reference it, we highlight it with all the supporting documents. So it's very easy for the underwriter, or it should be very easy for the underwriter to approve the loan. This is the second draw application for the Schedule C. Again, it's the same thing as the first, but on the bottom, you'll see the first draw loan and then also the gross receipts. I know, it looks like a lot because it's a big slide, but that's just the information.
Yeah, it looks daunting, but it's like an IRS form.
It's
Very
really not bad.
similar, It's not so bad. Once you do a few, we've done a few.
Yeah, the application is really not bad.
We've looked at a few.
The devil's in the details, it's like how the sausage is made. It's getting the right number for payroll. That's really where the problem comes in, and we'll talk about what payroll costs are.
Yeah.
And here we are, payroll costs.
There we are. Payroll costs start with at least 60% of the forgiveness has to come from this. Compensation not to exceed 100,000 per annually per employee. So obviously it's gross salary, gross wages, gross comp, and gross tips. Vacation, parental, family, medical, or sick leave, other leave for which the employer was reimbursed under the Family First Corona Response Act, allowance for separation and dismissal. Now, very important point, obviously, is the owner's salary. Good. Owner's salary is limited to.
Yeah, so the owner's salary, originally we thought it was going to be the same as for an employee with $100,000. This was a surprise that, when they didn't liberalize the law, the rules, they actually became a little more aggressive on it and said, we're going to limit an owner to $20,000 basically, or whatever their monthly amount would have been in 2019. What they're trying to do is they're trying to limit the amount of PPP funds that you can use, an owner can use to get forgiven. And they want to make sure the owner doesn't get a bump in pay. So you can't increase your pay as an owner, and you're limited in that aspect.
Got a few other good items in there. Look, we had to expect that was coming.
Yeah,
It was a very
it makes
generous
sense.
program the first time around. Employer contributions for employee group health, health, life, vision, dental. Employer contributions for employee retirement plans. This was a big mistake that people made. We saw that when people coupled together the salary and the retirement plan and lost the benefit without.
Yeah, so and unfortunately, we're still seeing things go wrong. So, payroll costs include the employer's contributions to health insurance. So if you pay an employee $10,000, right, that's $120,000 a month, $10,000 a month, $120,000 a year. That's $120,000. You're capping them at 100. They thought that the health plans and the employer retirement that stuff was included in the $100,000 number. It's not. It's in addition to. So that what you pay for your employees. I mean, for instance, my wife works for the company. They pay about $20,000 towards our health insurance. That would go for their loan. There were contributions for a retirement plan. So whatever the employer is paying, that would go. And also your SUDA, your unemployment insurance for New York State, all included in payroll costs, and it all get you a larger PPP loan. We are still seeing banks. I had an issue the other day with a bank that stated that, New York State unemployment is not included as a payroll cost. I had to go back and provide SBA documents and highlight them to show them that it is. And, the loan wasn't astronomical. It just made me think, what are the borrowers who maybe don't know that the unemployment is included, the unemployment insurance, the employment taxes, got shorted on a loan because the bank said, oh, that's not included. So it's stuff to keep an eye on. Next is non-payroll costs, which is 40%. I don't know if you guys remember, it used to be 75-25, that you could only use non-payroll costs on 25% of the forgiveness. Now they're allowing you 40.
This is really when we talk about credits later, it's going to matter even more. But obviously it's for mortgage obligations, the payment of interest, any business obligation of real property incurred before the 15th of 2020, rent pursuant to lease agreements. And we haven't talked about it yet, but you need to keep your documentation for this loan. So all your documentation needs to be maintained. It's important to have these agreements in place. I've seen a lot of people put leases in that weren't in before.
Yeah, we've also seen some banks push back on like co-occupancy agreements, so on and so forth. So it's anything that's not straightforward is becoming complicated to get forgiven, when in actuality it should be. I mean, they're legitimate expenses. Rent expenses is just a matter of the form of how it's put together. But yeah, rent, you got to have everything in place before February 15th. February 15th is really the date that they have chosen as when this really started to impact.
Yeah, and the utilities, which is the last really part of the original expenses from the first round of lending. Now we've got 4 more slides of new covered expenses, 5 more slides of expenses that weren't there, or 4 more slides anyway.
Yeah,
More expenses. They've liberalized this, which is going to help. So.
Yeah, I mean, what has happened is, they've added a bunch of expenses with the December 27th Consolidation Act.
Mm-hmm.
So it's going to allow you to use more for forgiveness. The first one is still up for debate as to what they actually mean. And what I say is, I don't usually read directly on slides, but I'm going to read this. they call it covered operating expenses, right? Operating, you think to operate your business, but the definition is a payment for any business software or cloud computing service that facilitates business operations, product or service delivery, the processing, payment, or tracking of payroll expenses, human resources, sales, billing function, or accounting or tracking of supplies, inventory, records, and expenses. Depending on how you read that and where the comma is and the semicolon, it could be business software and cloud computing services that facilitate all those things, or business software and cloud computing services that facilitate business operations, and everything else is separate.
I think it's probably the former, not the latter.
I do.
Right.
We think that
Just
it
because
really.
of the following slides, you know.
Yeah, I think that it
Yeah.
really has to do with
Yeah.
things having to do with business software and cloud computing, mostly because, listen, business has changed in the last year, and I don't know if it's going back 100% the way it was.
Yeah.
So many people are working from home. So many people have had to really create a robust IT support for their company, that I think this is here to stay,
Yeah.
in some way, shape, or form.
Well, listen, our own company, right? We sent almost 60 people home and said, okay, turn on your VPN. Let's see if it's going to work. We had a feeling it was going to work. We were set up for it.
Yeah.
And it's worked. And the whole world has advanced about, 10 years in 1 year, from a technological perspective.
Just to get to one of the questions, rent does include more than just space. It does, it does include equipment leases, yes. Somebody had asked that question. The next is property, covered property damage costs. This isn't really COVID related as much as it's related to, all of the vandalism and disturbances that we've seen pretty much since last summer.
Yeah, it's all incident related.
All
Yeah.
incident related.
Yeah.
They basically said, if you are not reimbursed from insurance, you can include that as a covered expense.
Yeah, I think that was a good thing. Supplier costs, expenditures made by an entity to a supplier of goods for the supply of goods that are essential to the operation of the entity at the time at which the expenditure is made and is pursuant to a contract or a purchase order that one had in effect any time before the covered period with respect to the applicable covered loan. Tricky language, right?
Yeah.
With respect to perishable goods in effect before at the time during the covered period with respect to the applicable covered loan. So it's kind of pull in supplies. And this was, I think it was helpful.
Yeah, I mean, for a restaurant, which is the second piece, the bottom of B2, perishable goods, it doesn't matter if that contract's in effect before or after. If you're not in perishable goods, they want it in effect before. The issue with all of these new covered costs, this passed on December 27th. It's March 9th. We still don't have any real guidance from the SBA in the form of frequently asked questions, so on and so forth. I think last time it took 6 weeks, 8 weeks.
They have not provided one additional FAQ since this came out.
Yeah, that's the complicated piece about this is that, again, we're all interpreting and we're not 100% sure exactly what is meant on certain items. It could be way broader than some people think. I just want to see, I see another question here. Yes, equipment lease is under the rental piece. So if you go back, we go back a couple slides. As long as the lease was in place as of February 15th of 2020, the copier lease, and if it's a restaurant, maybe it's a dishwasher, something like that, that could cover under the rental.
So the next one is pretty obvious, John, because this is all of the worker protection expenditures. So anything you've spent money on that includes sanitation for social distancing, your signage, or plexiglass, whatever you have put in place in order to meet the safety requirements related to COVID-19, and it can be really anything. We've seen a lot of things that people have put into play.
Yeah.
These plexiglass folks that distribute and make plexiglass, I mean, there is a run on it, especially with the schools, but even in our own office, we have plexiglass all over the place.
Yeah. I have a family member who does nails. They bought one on Amazon that sits on a desk. And I guess there's an area for the woman to put the nails in. Yeah, it
makes sense. Well, that's what it talks about. Renovation of assets to expand a drive-through window facility, indoor-outdoor combined air pressure ventilation filtration system. We've seen people, even our own building, they put all new filter vents and create new filtration. Physical barriers, sneeze guards, indoor, outdoor, look at what all the restaurants do. all the
Yeah.
outdoor ability to facilitate. Right now, the weather's, it's gonna get in the 50s now.
Yep.
So now, people who are summer vaccinated, some are not, but all the restaurants are gonna go back to outdoor use again. You know,
I mean,
Tents are
Cuomo
going back up.
announced 75%. What is it, March? What was the day he came with? Sometime within the next week, restaurants can go back to 75%, he said.
It's incredible, everywhere. Even
No,
the
not
city.
New York City. The city's at 25 or 35%, I think. But for Long Island, for the rest of the state, it's 75%.
Yep.
The other piece of this is obviously PPE equipment. So masks and stuff like that. You know, it's crazy if you would have told me, I've spoken to a lot of people about it. You would have told me last February or last January that we'd be walking around and wearing masks would be a normal occurrence, everyday occurrence. Most people would say you're crazy.
Yeah.
Not only is it a normal occurrence, it's created a new marketplace. It's created a new industry. I mean, we have clients that's all they do now is they make masks, custom masks for people. We have custom masks. Most of our clients have custom masks. So you know that PPE equipment would be covered. The one thing that they don't want to do as far as some of the expansions, it doesn't include residential real property or tangible property. So those expansions, you know, like for instance on the commercial end, the restaurants, you know, we have a lot of places by where I live. They have, you know, gazebos that went up and tents that went up that kind of are bolted into the building to try to create, you know, that are open on both sides. They're trying to liberalize and create more expenses that will allow you to get forgiveness.
Yeah, I think the interesting thing about the masks, twofold. You know, they've always worn masks.
Yeah.
So people are very compliant. And the other thing is there's no flu. We have no flu this year. So
It's true
we
that I
wiped
heard a
out
lot
the
of
flu.
eradicated the
Yeah,
flu.
we've eradicated the flu since we began wearing masks. So, so now I guess the Consolidation Act redefines the covered period to mean the date beginning on the date of the PPP loan, and then on any date selected by the recipient between 8 and 24 weeks. Now, again, they're really trying to make this work for the person who takes the funding.
Yeah, I mean, the unintended consequence of liberalizing some of the rules in July, I think it was, when originally it was only 8 weeks. And then they said it could be 8 weeks or 24 weeks. But there are issues with that because there were people that used their money in 10 weeks and had to let people go, and they would have had to have their forgiveness reduced. So this was Congress's way of saying, you know what, we identify a problem, we're going to fix it. You can have a covered period now anytime between 8 weeks and 24 weeks. It doesn't have to be 8 or 24. Now it could be 10, it could be 11 and a half, it could be 15. You could go to the last day that you needed covered expenses and go to that period. So it helps from that perspective where maybe you might have been reduced because of a reduction in employees after you ran out of money prior. Now that's not the case. And also, which is we're going to discuss later, it's really going to help from an employee retention credit end because now you can do both the PPP and the employee retention credit, and you may be able to maneuver the periods in which way you'll be able to qualify and receive money on both programs.
Big difference. And,
Yes.
and a lot of flexibility, which is what we needed, right? So now we have the FTE reduction. And there's a number of slides that talks about this, just to really get into how you calculate the number.
Yeah, there was a lot of confusion regarding this. You know, back last year, it was angst, confusion, no definition on what FTE included. How was it going to be done? Finally, the SBA came out. They said it's going to be based on a 40-hour week. You know, if you have a 35-hour week, it doesn't matter. It's based on a 40-hour week. Nobody can be more than a 1 FTE, FTE being full-time equivalent. And they said, listen, we know that this is onerous on the borrower. We'll let you have a simplified calculation also at your discretion, where if you're 40 hours or more, you're a 1 FTE. If you're less than 40 hours, you're a half FTE. And in some of the applications that we've done for forgiveness, we've calculated it both ways. Whichever way benefits the borrower, that's the way we go forward with.
Same here.
Now the baseline.
Now the baseline calculations, which, it's at your option. So the average number of FTE employees on a, payroll per month employed between February 15th, 2019 through June 30th, 2019. That brings us back all to last year, the calculations we originally did. And then the average number of FTEs employed from January 1st, 20 through February 29th, 2020. So really, what's the best option for you? Right?
Yeah, I mean, I think
Yeah.
what they did was they said, okay, we're gonna look at right before the pandemic, because it really didn't start to affect us until March 20.
Mhm.
Or if it's more beneficial, we'll look from February 15th of 19 through June 30th of 19. That was because originally in the CARES Act, if you read between the lines in the act, they thought we were gonna be out of this by June. And they thought that was gonna be the period that was gonna be affected.
You're right.
And that's the reason they use those time periods. And then they
I
threw in.
forgot about that. You're
Yes.
right. That's what it read. Yeah, you're right. The act did read that.
Yeah, and then, from a seasonal employer end, they threw a caveat of, if you're seasonal and this doesn't work, you can use any 12 weeks. Seasonal not being defined. So for 8 months, we had no definition of what seasonal meant. And then they came in and defined it as, basically, you have to not operate for 7 months or have very little revenue in any 6-month period in the year. So they've really restricted those that can use the seasonal employer option. And then we have the exemptions.
Yeah, these are exceptions for employees that the employer made a good faith effort to rehire the employee for the same number of hours and salary during the covered period. And this is where these unintended consequences come about, where people had folks come in, take the unemployment and not come back, and basically refuse the offer to come back and be employed again. So the employer, it was really incumbent upon them to maintain records of the offer and rejection and inform the state unemployment office of the employee's rejection, or they were fired for cause, they voluntarily resigned, or they requested and received a reduction in hours. So they made exceptions for things that could happen. We had a lot of people have employees
But didn't want to come
They
back.
don't
They were
wanna come
making
back.
more money on unemployment.
everywhere.
It
Yeah.
was crazy. And this is their way of saying, we don't want you to have a reduction in your loan forgiveness because of things that, we don't want you to, if there's somebody that should be fired for cause, you shouldn't hold on to them just to pay them, with the PPP if they're going to damage your company. If somebody voluntarily resigned, that shouldn't affect you. Somebody just asked a question, and it's a good one because it's an issue that we've seen. The question is, on the PPP application, it asks for the number of employees. Is this at the application or based upon the look back? I thought it was application, but curious why they ask if it's part of the forgiveness criteria. They're actually looking for whatever you're going to provide for the loan, the payroll amount. So if you're going to use, with the second draw loan, you have an option. You can use 2019 payroll, 2020 payroll. Most people are using 19 because their payroll went down in 20. So if you're using 2019 payroll to get your PPP loan, they want the number of employees in 2019. It is counterintuitive. It's not what you would think they would want, but there have been a number of people that have been flagged, and I've been receiving correspondence from people saying, the SBA is saying the number is wrong on the employees, and the bank has advised me that, it's not, and it's, for the most part, not clients of ours, but they've advised me that, hey, listen, they want the number of employees on the base period. They don't want the number of employees as of today. So, and the bank has even gone back to say, we're matching the number of employees to the 941 that you've provided, the 940s, the W-2s that you've provided. So they don't want the number of employees today, they want the number of employees as of the base period, which is not what you would think that they would want.
Right.
And it does cause potential issues, which we'll talk about later, from a standpoint of it could affect the loan amount now, where in the past it didn't. Now the SBA has put something out that it's affected the loans, but they haven't specifically stated it to anybody. And we'll talk about that in a bit.
Yeah, I think this next one, John, it's interesting because I just had a call from somebody about FTE reduction exception. The employers that show an inability to rehire individuals who are employees on 2/15/20. So folks that got other jobs or don't want to come back, we just said,
Yeah.
and an inability to hire similarly qualified employees,
Yeah.
which is very important, especially for technical jobs.
Yes.
For unfilled positions on or before 12/31/20. I got off the phone with a client yesterday who does fine woodwork and cabinetry and could not get their people back.
Yeah.
They couldn't find them, and they were off doing something else and are concerned because now they're going to start to open up again and they got to find new people to do work for them.
That's
Next is next we have the safe harbors.
Yeah. So
Go ahead.
the first safe harbor is if you reduce the FTE level between February 15th and April 26th of last year. If you did, right, so that's basically the time period right after when everything was going on, and then you restored the number of employees afterwards, either December 31st for a prior loan or the end of your covered period for any new loans, you won't be punished. So if you had 100 FTEs, you reduced it down to 50 FTEs in March, and then you went back up to 100 FTEs by the end of the year, they're not going to punish you for having only 50 FTEs during the covered period. So that's one of the safe harbors that's available. The other one is, and they've added this more recently, if you're unable to return to the same level of business that you had back on February 15th of 2020 because of compliance with governmental orders, right, during the period, then that's another exemption. So, what does that mean? Well, if the government, we were just talking about restaurants, right? The New York State has said, you needed to be at 50%. Right? Was it 50 or 25% here right now? I don't even remember. It was 50%, right?
Mhm.
So they've cut the amount of people that you can have in your restaurant down to 50%. That's going to keep you from doing the same level of business unless you have, some crazy DoorDash, Uber Eats, and all those type of stuff. So if
And we have one of those.
we do have one of those that they changed their model and actually had a very good year last year after this happened. But if you're a traditional sit-down restaurant and you have 100 tables, now you can only have 50, you're going to lose revenue and not be able to do the same level of business activity. They've said, okay, if you have to reduce your FTE, right, it makes sense. If you only have 50 tables, you don't need the same amount of employees to service 50 tables as you would 100. So they understand that you're going to have to reduce your staff and that you won't be, you won't be punished.
Well, this is good though, because this was there in the first, but they liberalized this. They made,
Yeah.
They made it wider and more easily, for people to qualify, which I think was really, really important,
This is the salary reduction. So the first piece is the FTE. The second piece that may affect you is if you reduced somebody's salary by more than 25%. And we had a law firm that basically across the board went 25%. And reduced everybody.
Yeah.
Here, it's if you have somebody that's making less than 100,000 and you reduce them by more than 25%, you are going to have a reduction in your forgiveness.
Yeah, we had a lot of firms that furloughed people. Furloughing was big, where they let go, 15, 20, 25%, or they reduced salary for people across the board and kept everybody.
And somebody asked, what if you were indirectly impacted, meaning that your client is a restaurant?
Yes.
That's definitely in the gray, but I think there's an argument to be made that your entire revenue source is dried up, right?
So if you were a CPA and all you did was restaurants.
Yeah.
And there was a big cutback, and they cut back your fees or let you go.
That's,
you're in the park.
It can go either way. It's really going to come down to how comfortable the borrower is certifying that, because they are certifying it. They're certifying that they qualify. So I think there needs to be a reasonable expectation that that you believe that that'll survive.
Yeah.
So these are the PPP forgiveness applications. The new one is the Form 3508S, 3508EZ also we'll talk about. They've basically made it much simpler and easier for people to gain forgiveness. The 3508S is very small, very concise, one page, anything under $150,000. And all you have to do is disclose the amount you spent on payroll and disclose the amount that you're asking for loan forgiveness. You got to certify that you're using the funds properly. You didn't, that you had a 25% reduction in revenue if it's a second draw loan, that you use 60% of the payroll on forgivable costs. And loans that are more than $50,000, you have to still comply with the FTE reduction and salary reduction provisions. So anybody 50,000 to 150, the 50,000 has an exemption. This is just
the form.
It's
But
just
we should talk too about where forgiveness is at right now, because it's really not anywhere.
a lot of banks aren't even accepting it.
Not accepting it right now. They're dealing with the administration of the second drawer
Yep.
and the continuation of the first drawer. Because we have people every day contacting us. I want to put my loan and we understand what they want to do. They have time. I mean, we have all the way till
Yeah, you have time. I think
October.
the issue becomes, especially now with the employee retention credit that we're going to talk about in a couple of minutes, just coordinating the two programs because, when forgiveness first came out and they liberalized rules, it was like, all right, I'm just going to go and just use payroll. I'm not going to use the other costs, non-payroll costs, because it's a pain in the neck to get all the documents together and so on and so forth. It is a little more onerous where if you have a payroll service, you can just provide the payroll document, call it a day. Now you're going to want to fill that 40% bucket because to the extent that you can fill the 40% non-payroll costs, you can now get an employee retention credit for whatever you don't take for forgiveness purposes. So this is just the 3508S. It's very simple. You can see it's on the bottom. It's only asking what your payroll costs, what your loan forgiveness amount. The next one is the 3508EZ. These are for people that don't qualify for the 3508S. So maybe they're more than $150,000. And it does require additional disclosures and documents. You have to certify that you've not reduced any employee's salary by more than 25% if they were making 100K. The borrower must certify that there's no reduction in FTE, and also certify that you use the PPP funds for at least 65% and had the 25% reduction. This is just the application. You can see it's much more detailed than the 3508S, which is really just asking how much you spend on payroll, how much you ask for forgiveness. This one, every category is covered. How much did you spend in utilities? How much did you spend in supplier costs? How much did you spend in payroll costs? And then they're talking about the potential forgiveness amount, and they're testing that at least 60% is on payroll. Not just asking you to certify, they're actually testing it in the form.
This is the big kahuna.
Yeah, this is a big kahuna. We have one particular client that has a very large loan. I think we have 80 hours into putting documents together for this forgiveness application.
We have a few more to
Because
come.
they have, they have hundreds of employees. So it's a full application. There's significant FTE and other calculations. It's very voluminous. It requires a significant amount of documentation that you need to provide with the form to support. So this is, I think there's a couple of slides here, but this is, the front page where it's showing the different amounts, then the salary, hourly, the FTE, if there's any reduction there, any other potential forgiveness. This is actually even the older form because it doesn't have the new stuff on it. Then you have worksheets that support this, that talk about, cash compensation, reduction in FTE. If you do have any safe harbors, what the owner's compensation is. So that's Schedule A. In addition to that, there's a further safe harbor 2 calculation. And then you got for every single employee, the employee's name, their identifier, the cash compensation page, paid. What was their average FTE during the base period? Was there any salary or hourly reduction? Both for people with and without making $100,000. So it does. It is very voluminous.
We are urging people, if you have to go this route, to begin the process early. It takes time to put it together and get it done. We don't know when you're going to be able to submit it, but you need to get it done while it's fresh. You have all the documents, get it done, and then complete it, right? These are necessity applications, John, 3509.3510. In addition to the forgiveness applications for those with loans of $2 million or more that we talked about earlier, the SBA, we expect, will review the certification that you needed the funds due to the economic uncertainty at the time of application. Failure to complete and provide this will probably result in the SBA determining the borrower is ineligible for the PPP loan and seek repayment from the borrower. We know of one client that returned a loan, that got one and returned it.
Yeah.
But probably was some others.
Yeah.
And we have some large ones that we've said up front. You need to get intimate with this and understand what they're looking for.
Yeah, I mean, so the 3509, I think, is for for-profit borrowers, and 3510, I believe, is nonprofit. I could have that switched. Yeah, I mean, in addition to asking a bunch of questions, which we'll go over in a couple minutes, they're also asking for all the supporting documentation for it. So it's we have a client that we're working with right now. They're putting all the documentation and support together, and they're creating a narrative they're going to attach, because there is an area for a narrative, to really kind of tell their story to the SBA in hopes that they don't say that it wasn't necessary. But there's two main parts to the form. There's a business activity and a liquidity. We're oversimplifying this for today, just to make you aware of it. But some of the items, the highlights, they want documentation of the sales in Q2 of 2020. So obviously when the pandemic first started, it was the worst. versus Q2 of 2019. And to see, you know, what was the reduction in sales. They want to know, were you affected by a government shutdown? Not everybody shut down at the same times and so on and so forth due to COVID. They want to know information regarding if you shut down, it wasn't from a government, you decided to shut down. And they want information regarding if between March 13th and the end of your covered period, did you start any new capital improvements that were not related to COVID? They want to know, did you take this money in and go expand a house or go expand, you know, a business and
Right.
use it for expansion rather than for what the purpose was.
Purpose is one thing, liquidity.
Liquidity.
And that's what we're coming to next, and working capital.
Yeah.
And I think that we had lots of talks with different bankers at different banks that we know. The first phase was all about liquidity, and everyone's view was, let's see where we are next January, meaning
Yeah.
last month or 2 months ago. And now we're still putting liquidity in. So we don't really know, because after liquidity comes solvency. So we really haven't gotten to that point yet. But they want to know, you know, cash and equivalents on the last day of the quarter prior to obtaining a PPP loan.
So if you take a
Yeah.
loan in April, they want to know
Yeah,
how much cash did you have as of March 31st?
yeah, between March 13th and the end of the covered period, did you make distributions to yourselves? The business prepaid any outstanding debt? Any employees owners were paid more than $250,000 annualized? The book value of the borrower on the last day of the quarter, the calendar quarter, just prior to obtaining the PPP loan. So they're asking some very pointed questions. We don't know what they're going to do with the information, what that's going to mean after.
Yeah,
Yes,
they want to know where's the money going, you know, from your business. You know, they don't want it to come in the front door and out the back.
Right.
To the owners. They don't want you to be, you know, if you had debt, to just prepay all your debt with it, so on and so forth. So they're really looking at everything and asking for support and documentation. They're going to make an assessment whether you had the liquidity to get through, you know, this without taking this money. And that's where they're going. We just don't know how they're going to administer the program.
I think the problem that we see, though, is that it was so dire back then.
No, I know.
And people just did not know what was going to happen. Remember, we were coming to the office, there were two of us in a place that holds 50, 60 people.
Yeah.
There were no cars in the expressway. It was like an episode of Twilight Zone.
Oh, when we put that letter together, I was driving around with a letter and my business card saying I was an essential worker, because we were, because there was a time period, I don't remember, we were concerned that cops were going to start pulling people over.
Yeah.
We wanted to have support for all of our employees, whoever was traveling here, there weren't many, that, listen, if you get pulled over, you can have a letter with your business card to show them that you're supposed to be here. You're supposed to be traveling. It was, you know, I think as the further we get away from it, the more people are going to forget what it was really like. And I think that's my biggest concern, is that, you know, they may be aggressive on some standpoints and not really going back to what was the time frame, what was everybody's mind frame during that time.
Yeah. Oh, yeah.
There's the PPP tax treatment. I kind of gave you a preview earlier on, but you know, like we had said before, the IRS came out and said it was taxable. You needed to include it in 2020, whether you got forgiven or not, and now it's not. The Consolidation Act at the end of December basically clarified, overruled the IRS, and basically made it crystal clear that it's not taxable. You know, no amount should be included in gross income, and no deduction should be denied. They've also even addressed basis issues, which I don't want to go too crazy, because this is not, you know, we're not talking to a bunch of technical CPAs today, but it's, you know, it helps the owner is really what the, you know, what the gist is. And there are some states that are not following this. New York, thankfully, is, but depending on what state you
Do you
operate
know
in,
what state is not following?
there's I think North Carolina's not, there's a bunch. I mean, there's a listing. I have a
No,
listing.
not operating.
Yeah,
I haven't seen it.
No, I'll send it to you. I have a listing of every single state and who is and who isn't.
Yeah.
And then this is just more of a technical line. The forgiven loan is treated as tax exempt income and increases the basis.
Well, our advanced tax treatment, the IDL, so the Consolidation Act repeals and eliminates the section of the CARES Act which reduces PPP forgiveness by the EIDL loan advances amount. That was the $10,000 that people got up front or less. Allows borrowers to obtain full PPP forgiveness, regardless if they received the previous EIDL loan advance, which was, the EIDL loan advance was one of the first things that was out of the gate for people. And we had a handful of people qualify, because that went away really quick. The EIDL loan is treated as tax exempt income and increases the basis through the OAA account, as we said before, for S corps, and the IDL loan program is open to the end of this year now.
I don't know if the advances are still available. It's just a
No.
loan. The
Just a
advance, when it originally came out, was supposed to be $10,000.
Yeah.
Then the SBA, I don't want to say arbitrarily, but they, on their own, changed the rules. The CARES Act specifically said one thing, they administered a different way and said it was $1,000 per employee. I think that was to ration the funds and make sure that everybody was, who was entitled to it got it. So it kind of changed a little bit. The caveat to that was if you got an EIDL loan originally, if you got a PPP loan, you couldn't get forgiven for the entire PPP loan. You'd have to take the EIDL loan off of it. So the banks were going to be left with a lot of $10,000 loans. And then they fixed this, thankfully, in the Consolidation Act. It helps both the borrower, because now they can get full forgiveness if they're entitled, and it helps the bank. They don't want a bunch of low interest, $10,000, balance loans.
Yeah, we like, again, we're gonna repeat, we like the EIDL financing. We think it's smart for people to take less than 200 grand, 200,000. You can always return it early. There's no prepayment penalty. It's working capital. It sits on your balance sheet. It's cash flow. It's cheap money. It can help you through a rough time, and we like it. We think people should look at it
Go
seriously.
through this kind of quickly because of the new validation checks. What the SBA did was they put a bunch of validation checks in on these new loans since December to try to combat fraud. The problem with that is that it flagged a lot of legitimate applications. That there's the figures of 20 to 30% from what we can see, and it's holding up those amounts. Also, they put a cap in where you can only get $35,000 per employee for the applications, which is something new that nobody, was really knew about. So these are some issues. And then on February 10th, the SBA finally said, listen, to speed up the process to fix it, they're not going to require the lenders to provide all the documents. And if the lender is comfortable with the application, they will allow it to go forward.
Yeah, I think in the next page, we still have a lot of other points. Confusion regarding the time period for the number of employees requests on the second draw application. Lenders requesting additional information already in their possession. That was a big one that we had in the beginning. Lenders coming back wanting additional information. Requesting proof of a 25% decrease in gross receipts for loans less than 150, although not required for the SBA. Lenders requesting copies of 2020 tax returns not yet prepared and filed and not required to provide. Again, we felt that they were trying to put some more restraints around the lending program, which rightfully might make sense, but some of it didn't make any sense, like tax returns that you can't possibly have done.
Yeah, the problem here is that in the Consolidation Act, they specifically tried to make it easy to get funding for the second loans and get it out quickly. And then the banks who are administering these loans directly did not comply with what the SBA said and the SBA's own regulations, which was frustrating because, we're reading these regulations and hundreds of pages of text and advising clients, and then the bank is coming out and doing something completely separate from what the actual regulations from the SBA say. And it did end up, it's caused some issues. We've also found miscalculations by the bank. We have an anonymous attendee that's saying the amount we received for PP2 was less than PP1 with the same information. Did the second bank or SBA miscalculate, or the parameters of the law different? We'd have to look at your calculation to really tell you. It's one of a couple things. It could be that you made a mistake on the first application and the bank, the second time they caught it. It could be that the bank made a mistake. It could be this $35,000 per employee parameter that was put in place. I don't know if it's still in place. It was in place in February. I know that there's been a handful of different items that the SBA has been fixing, for lack of a better word. But it was probably one of those three. But we're seeing a lot of the text from the SBA says this, but the bank is requiring that. And we're not going to use names, but some of the smaller and mid-sized banks have been complying with what the SBA has indicated, and some of the larger ones are not. And that's the most frustrating piece of it.
And we think there's an outsourced aspect to this, that some of the loans have been outsourced to maybe parties who aren't trained or are really towing the line and really holding firm on what they're going to issue and so forth. But again, some of that speculation on part, we don't know for sure.
Yeah.
But the rest of the slides, we're going to spend a bit of time right now because we're at 2:20
Yes, we got
on the
10, 15
retention
minutes.
credit, which is really important because this is a great new development, right, John? Great.
Yeah,
development.
so the employee retention credit has been around since the CARES Act. But what has changed is they said if you get a PPP loan, you can't take the employee retention credit. So what happened is a lot of not-for-profits that maybe couldn't apply for the PPP loans were going for these employee retention credits, so on and so forth. What has changed is the Consolidation Act at the end of December. They changed the rules and said you can go for an employee retention credit and have a PPP loan. You just can't use the same wages for both. So you can't say, John had $10,000 worth of wages. I'm going to use those wages to get forgiveness, and then use John's same $10,000 worth of wages to get the employee retention credit. So they said to the extent that you don't use them for the PPP, then you can use them for the employee retention credit.
John, I'm gonna give you a hypothetical.
You can resubmit. Somebody asked, can you resubmit your application if
Sure.
it's incorrect? There's actually a whole section in the Consolidation Act talking about that. So you should be able to resubmit.
And the banks do encourage that. So let me give you a hypothetical on the retention credit.
Yeah.
So you determine that you've got $100,000 of retention credit coming to you. Okay. So let's walk through the tax treatment. What do you have to do?
Yeah. So
In simple terms, high level.
high level, let's say it's for 2020. You'd have to go back, amend your payroll tax returns for 2020. You'll
But
get
specifically your 941.
your 941. You'll use what's called a 941X to amend the tax return.
Right.
You'll get a credit. And then what you're supposed to do is that credit is supposed to come and become basically taxable income on your tax return for 2020. So this change was in December. We've been waiting guidance from the SBA in regard to this. I believe it was last week. They dropped a 104-page document. And now we have a little better indication of exactly the way everything's going to go. And we're putting a lot of people on extension so that we can put them on extension. We can evaluate the employee retention credit in unison with the PPP to make sure that, wages aren't being counted twice, so on and so forth, and then apply. And then we're gonna have to pick it up in the 2020 tax return, and then we'll file the tax return.
Right. So let's do the math. Got 100, you get $100,000 credit, comes to the 941. Your 941 is going to be reduced. You're going to get that credit back.
Yeah.
Now you pick up the 100 as your income. So you're an escort. You pick up 100.
Yeah, it'll flow through.
Right. And
If
the
you
tax
get
impact is.
let's say it's 30 grand, so you get 100 in the credit, it costs you 30,000 in tax. You're still net up 70,000. So a lot of people are going to do this, and listen, if you're eligible, you should. So let's talk about the eligibility. So there's different for 20 and 21. The credits are different amounts, the eligibility is different. For 20, the credit's equal to 50% of eligible wages for a maximum of $5,000 per year per employee. Eligible wages are $10,000. So you get 50% of $10,000 per employee per year. So you get $5,000 per employee. There's different rules on sizes. If your average employee is 100 or fewer during 19, qualified wages include wages regardless if the employee is providing services or not, right? Whether they're working or not, it qualifies. If the employer is more than 100, qualified wages only include when you're paying an employee and they're not doing it, okay? To qualify you, and this is important on both these credits, to qualify you must either be fully or partially closed due to a government order, or have a reduction of gross receipts of at least 50%. So you either got to have a reduction of 50% quarter over quarter, quarter 2, 2020 to quarter 2, 2019, for instance, or you got to be fully or partially closed. Now, pretty much all the restaurants are partially closed, right? If you're at 50% capacity, you're partially closed. There is a whole listing on the IRS website as to what qualifies for fully or partially closed. But a lot of people will actually qualify.
Yeah, a little different, like you said, for 21, but a valuable credit. That's why we spent, the last 4 or 5 days calling clients.
Yeah.
And saying, look, we need to extend your tax return for March 15th because we need to.
Yeah, we actually already addressed this.
Yeah.
For 21, the difference is that now it's 70% of eligible wages, right? So 70% of $10,000, which gets you $7,000 per employee, but now it's per quarter. So where in 2020, you were entitled to $5,000 per employee, now you can get up to $14,000 per employee over the first 2 quarters. And they've also changed the qualifications. So now, if you average 500 or fewer employees, anybody qualifies, where if it's more than 500 employees, it's only people that you paid and don't do anything. And the other thing that changed for 2021, rather than a 50% decrease in revenue, now you only need a 20% decrease in revenue. And there's a whole bunch of rules, which we're not going to go into, about, how many quarters can you claim it if you qualify. But this is something you should definitely be talking to your accountant with.
And also, John, on that last part, just to qualify, either fully or partially closed due to government orders, or have a reduction.
It's one or the other, not
That's
both.
really important. So you don't need to
Yeah.
be partially or totally shut down. That's the difference between the two periods. And that you made the emphasis in the or. That's the most important thing.
Somebody said, can we choose which quarter we use to show the reduction in revenue? Yes. So, what'll happen is, if, let's say, most people are going to qualify in quarter two. So if quarter two of 2020, when compared to quarter two of 2019, has more than a 50% reduction for 2020's credit, or a 20% reduction for 2021's credit, you'll qualify in that quarter, right? Whatever quarter that is. And then you'll qualify in every quarter until you recover to a standpoint of 80% of your total revenue. So we have somebody, they have a 70% decrease in the quarter two of 2020. Then the following quarter, they only have like a 10% decrease. So they don't qualify anymore, right? But what happens is, the way the program works, in the quarter that you no longer qualify, they actually let you take the credit for that quarter. You just can't take it the quarter after. So if you, and this is fairly complicated, but if you qualify in quarter two, you really qualify at least in quarter 2 and 3. Because if you recover in quarter 3, you just don't qualify in quarter 4.
There'll be a lag, what you're saying.
There'll be a lag. We will send the presentation.
And I think, John, the other thing too, we have some folks who did not qualify for PPP, but are very eligible for the employee retention credit.
Yep.
And they've been calculating employee retention credit as well.
So if you use an employee's wages for PPP for 24 weeks, but don't use, if you use it for PPP, you can't use it.
Can't use it twice.
Can't use it twice. I know we only have 3 minutes, so
No
just give
double.
1 second.
Anthony, we're moving it along.
We're moving along, Anthony. Just give us 3 minutes.
Yeah.
As far as the question for the employees, maxing out the 5,000 credit each, what do I hold out of PPP? You have to hold the 10,000 out, not the 5. Let's just go here. We won't talk about the shuttered venues. What's important here is just that there's another program for theaters and Broadway theaters and so on and so forth.
I think
That's
the
available.
business meals thing is a big thing. That was
Yeah,
that
I
was
just
our
wanna-
former president's addition.
I just want to get to the other
Yeah.
new tax incentives. The first is that for 2000, not for 2020, but for 2021 and 22, 100% of your business meals will be deductible.
Right.
Normally, it's only 50%, which is what this year is. The only thing is entertainment still isn't deductible, so we have a big joke. If you go and you go to play golf with a client, the golf isn't deductible, but all the drinking on the golf course and the meals that you have after would be.
Yeah, and this is the Trump provision, right? Then we got charitable contributions, which were, again, we had a couple of real late, joiners in the end. 100% of your deduction of cash out, charitable contributions up to AGI. For itemized filers up for 2021 were deductible, as well as the smaller ones for 300.
So basically, if you don't itemize, if you're single, you can,
Yeah.
for cash contributions, you can take up to a $300 deduction. For married, it's $600. Consolidation Act just extended the 100% deduction of cash charitable contributions for 21. And the last thing is flexible spending. Usually it's a use it or you lose it. Because of what's going on with COVID, they're now allowing you to move funds over from 20 to 21, and then also from 21 to 22. And there's like a one-time provision in 21 where you can modify prospectively the amount contributed to the plan. So this is just, we will send out the slides.
Yeah, but I would say, John, the one last thing to leave people with is that this is a great program. It's really worked well. There are going to be some significant tax law changes. We're not sure when. Some of them may be retroactive to January 1st. You need to pay attention. Hopefully we'll be back. We'll do something when the tax law changes as they come through. Anthony, we thank you.
Yeah, and well, one last question that we got having to do with the PPP. To the extent that you can limit your application for forgiveness to 60% payroll costs, will obviously allow you to take more when the employee retention credit. And that's why I think that the employee retention credit and the PPP applications have to be looked at in unison to make sure that you're really maximizing what you're entitled to.
And you have to extend your tax return if you do next week.
You should, yeah.
That'd be the
That's
best.
our standpoint.
Otherwise, you're gonna amend.
But if you haven't gotten these PPP programs, you only have till March 31st. So definitely
Move.
apply, move, speak to your consultant, speak to your accountant, and move forward with it.
Anthony, thank you. Thank you, Anthony.
No, this was great. This is a lot of great information. And the only comment I'm going to make is, as a business owner, I would not want to attempt to do all this alone. I definitely would have to reach out and get someone's guidance and thoughts as we go through this whole process. But I want to thank you. I want to thank all the attendees today. I hope you got something out of it. Like we said, the deck will be sent out to everyone that attended today, and have a wonderful afternoon, and thank you so much.
Thank you, everybody.
Take care. So long.
All right.